Does your tax bill totally bum you out? Do you wish there was a way to get more tax savings for self-employed business owners? There is a way! Many ways. And today I'm sharing tax saving tips for small business owners. After this video, you'll have 7 tax saving strategies to help you lower your tax bill, and you'll probably be feeling like a tax savings unicorn and doing some sweet dance moves. Before we get into my tips, I'd love to know what your favorite tax saving tip is. Let me know in the comments below. And now it's time for me to share my favorite tax savings tips. Claim your tax deductions. Tax deductions are a major player in lowering your tax bill. The way tax deductions work are that they are deducted from your total revenue, which is all the money that your business earns. What's left are your taxable profits. So the more tax deductions you have, the lower your taxable profits, and that lowers your tax bill. If you don't know what a tax deduction is, check out my video, What is a Tax Write-Off, which goes in depth about what tax deductions are, how they work, and how to know if something is a tax deduction. So you might be thinking, this is pretty obvious. Yeah, I'm gonna write off my business expenses, but here's the thing. A lot of small business owners are letting their tax deductions fall through the cracks. This is either due to poor record keeping or by using your personal cards to pay for business expenses. I always recommend that at the end of the year, you scan your personal bank and credit card statements and look for any business expenses you may have missed. The other tax deductions that slip through the cracks are what I call split expenses. These are business expenses that are both personal and business. A few examples are a percentage of your cell phone bill or home internet if you use them for your business. The way it works is that you write off a percentage of the expense that is for business. So if your phone bill is $100 a month and you use it 50% for business, then you can write off $50 a month or $600 a year. You can learn more about split deductions by going to the blog post linked below called Three Types of Tax Deductions and How to Track Them. And if you've never gone deduction hunting before, check out my mini training, Panic Free Tax Prep, which walks you through how to find all of those sneaky deductions. Take the mileage deduction. The poor mileage deduction. This is one of those deductions that people always blow off, but it adds up to so much. The way the mileage deduction works is that every year the IRS sets a mileage reimbursement rate. For 2018, the rate is 54.5 cents a mile. You multiply the mileage rate by your annual business mileage and bam, that's your tax deduction. So if you drove 5,000 miles for business, you would multiply 5,000 by 0.545, and that's $2,725, which is your tax deduction. Even though the mileage deduction can give you big tax savings, most people think it's too much of a pain to track, so they skip it. But there are ways to automate your mileage tracking. My favorite is an app called Mile IQ that knows when you're driving and automatically tracks your mileage. You don't even need to turn on the app when you get into the car. All you do is log your mileage as business or personal. I've linked to the app below, which is free for the first 40 drives a month. See if you qualify for home office. Home office is one of those deductions that people are really scared of taking, even though it provides major tax savings for self-employed folks. If you legitimately have a home office for your business, then you should have nothing to fear. The biggest home office mistake people make is not claiming their home office. A home office is defined as an area of your home used exclusively and regularly for business purposes. Exclusively means it cannot double for anything else. Yes, that means your kid's playroom is not technically a home office. That also means your dining room table or couch isn't going to fly as a home office either. Regularly means you have to use it on an ongoing basis. So you don't have to use it daily, but you can't just use it once a year and be like, this is my home office. It's all about consistency. If you consistently use your home office once a week, that's regular. If you do qualify for home office, then hop on the ride to tax savings glory because home office is a biggie. So the way it works is that you can deduct a percentage of your home office expenses like your rent, mortgage, utilities, homeowner insurance, and renter's insurance, and cleaning costs. The percentage you deduct depends on the percentage of your total home square footage and the percentage of your home office square footage. If your home office is 15% of your total home, you'll deduct 15% of these expenses. So the easiest way to figure out what percentage of your expenses you can write off is to measure your total square footage of your home and your home office. Then you'll divide your home office square footage by your home square footage and voila, you've got your deductible percentage. Let's do some mathy math. If our home is 2,000 square feet and our office is 500 square feet, then we can deduct 25% of our home expenses. 25% is a lot. If you spend $3,000 a month on your home, that's $750 a month, which is $9,000 in a year. That's some serious tax savings. Turn charitable donations into expenses. Here's the deal. Charitable donations are not business deductions. Rather, they are personal deductions that you itemize on your tax return. But not everyone itemizes personal deductions because the standard deduction is way more than their itemized deductions. And this is going to be even truer this year because the standard deduction has nearly doubled for 2018's tax year. What that means is that you're probably not going to itemize a few $100 donations. So how do you make these donations a tax deduction? By turning them into expenses. If your donation is directly related to your business, then you can deduct it. The trick is that it needs to be something exchanged for your contribution that somehow benefits your business. So the easiest way to support charities and get a tax deduction is to sponsor events and programs. As a sponsor, your information is often listed on promo materials, which means your sponsorship becomes a marketing expense. But what if you donate time or services to a charity? That's deductible, right? That's going to be a big no. You cannot deduct the value of the time that you donate to charity, but you can deduct travel expenses, mileage, and other direct expenses related to donating your time to charity. For example, if you donate time to photograph dogs at your local shelter, you can donate the cost of supplies that you purchase, like dog treats and toys. You can also deduct the taxi that you take to get there, but you cannot deduct the value of your time. Contribute to a SEP IRA. A SEP IRA, which is officially called a Simplified Employee Pension, is a special type of retirement account for business owners and self-employed folks. The reason that a SEP saves you money on your taxes is that it is a pre-tax retirement account. That means you're not taxed on your yearly contributions, which means it lowers your taxable income. For example, if you will have $100,000 in taxable profits and contribute $15,000 to a SEP, you will be taxed on $85,000, not the original $100K, which is pretty awesome. So what's the catch? Well, first, your annual contributions cannot be more than 25% of your taxable income or $55,000 a year. Second, if you have employees, you must contribute the same amount that you put into your SEP into their SEP. So if you have employees, you definitely need to do some math on this. But if you're a solopreneur, a SEP is a pretty sweet deal. The other thing to keep in mind is that while your contributions are not taxed the year you make them, you will be taxed on the money when you withdraw it in retirement. So a SEP is not a no tax situation. The taxes you pay are deferred. SEPs can seriously lower your tax liability. Last year, my wife and I saved 40% on our tax payments by contributing the max allowable to our SEP, and we saved for retirement. Deduct health insurance costs. Pretty much every business owner knows that paying for health insurance is a nightmare. There are very few affordable options for self-employed folks. But the good news is that you can deduct health insurance costs on your taxes. Now, your health insurance is not a business deduction or expense, but it is a personal deduction, and it's not part of your itemized deductions, which means regardless if you take the standard deduction or not, you can still write off your health insurance costs. So to deal with this one is that you and your spouse cannot be eligible for an employer-subsidized health insurance. So if one of you even has the option to get health insurance through a job, this deduction is going to be a no-go. But if you're single or both self-employed, then you can save some serious money. Also, the amount of the deduction cannot be more than your net profits. So if your net profits are $10,000 and you pay $13,000 for health insurance, you can only deduct $10,000 rather than the full $13,000. But whatevs, it still is a huge deduction on your taxes. See if you qualify for the 20% pass-through deduction. All right, let's talk about the 20% pass-through deduction that was part of the 2017 tax reform. Depending on the type of business you have, you may be eligible to write off 20% of your profits. Yes, you could potentially pay taxes on 20% less of your profits, which is major. In the most simplest of tax scenarios, it works like this. You have $100,000 in qualified business income. With the deduction, you could deduct up to $20,000. And I say could because this deduction has a lot of fine print. Now, not everyone qualifies for this deduction, so you do need to talk to a tax preparer about this to make sure that you're eligible. First, you need to have a pass-through entity, which is basically everyone who is not a C corporation. Second, you need to have qualified business income, which is an overly fancy way of saying your business nets profits. And there are some types of income sources that are not eligible for the pass-through deduction, which is why you need to talk to a tax person. Lastly, your qualification will depend on your income and type of business. If you earn under $157,000 or $350,000 if filing jointly, regardless of the type of business you'll have, you'll probably qualify. But if you earn over those thresholds, then there are additional considerations that have to do with your industry and if you're a service-based business. Now, there are a few more nuances than what I'm going over here, which is why this tip is see if you qualify, because this video cannot tell you if you qualify. But I've linked to a blog post below that walks you through how to tell if you qualify for the 20% deduction and how to see what your deduction could be. So as you can see, there are so many ways that you can save money on your taxes. Combining even just a few of these tips will still give you major savings on your taxes. So I have something super special for you, which is my Biz Finance Survival Kit. It's free and not only comes with a tax prep checklist, but it also includes 4 other cheat sheets and checklists for your small business. You can download the free survival kit using the link in the description. If you like this video, let me know in the comments below what was your biggest takeaway. And make sure you subscribe to my channel because every week I share a new video about how to organize and stay on top of your business finances. I'll see you in the next video. Bye.